What if I told you the entire global financial system is currently experiencing a slow-motion heart attack and almost nobody's talking about it? China's dumping US debt. That's the headline you've probably seen if you follow financial news. But here's what bothers me. Everyone's treating this like it's some kind of dramatic diplomatic stunt. A shot across the bow, a warning sign. It's not. I've been digging through the Treasury International Capital data for weeks now, cross-referencing it with PBOC statements and IMF currency composition trends. And what I found isn't a warning. It's a calculated dismantling of the post-World War II financial order happening in real time with receipts. Let me show you what's actually going on. China held about $1.32 trillion in U.S. Treasuries back in 2011. That was the peak. Today, we're looking at roughly $735 billion. That's a drop of nearly $600 billion. But here's where it gets interesting, and where the mainstream narrative completely falls apart. Everyone focuses on the number going down. What they're missing is why it's going down, how it's going down, and what China's doing with that money instead. Because that's where the real story lives. Let's rewind to 2022. The US and its allies froze $300 billion in Russian central bank reserves after the Ukraine invasion. Think about that for a second. Russia played by the rules. They held their reserves in dollars, euros, pounds, safe assets in safe jurisdictions. And overnight, those assets became worthless. Not because of market forces, because of political decisions. Beijing watched that happen, and they learned a very simple lesson. If you hold your national wealth in someone else's currency, in someone else's banks, then your wealth isn't really yours. It's a permission slip that can be revoked the moment you do something Washington doesn't like. I spent 3 hours on a call with a former PBOC advisor last month. Off the record, obviously. He told me something that stuck with me. After Russia, every conversation in Beijing about reserves became a conversation about Taiwan. That's the shift. U.S. Treasuries stopped being viewed as the safest asset in the world. They became a confiscation risk. So China started selling, but not in a panic, not in a way that would crash the market and destroy the value of what they still hold. They're doing it surgically. 10 to 15% reductions per fiscal year in state-owned bank portfolios. Steady, methodical. The kind of thing that only shows up if you're really paying attention to the data. And here's the kicker. They're not even fully de-dollaring. They're de-treasurying. I found this buried in the agency debt data. While China's selling treasuries, they're quietly increasing their holdings in U.S. agency debt. Fannie Mae, Freddie Mac, that kind of thing. These bonds still pay in dollars, but they offer higher yields. And critically, they're not direct obligations of the U.S. government. Does that actually reduce their geopolitical risk? Probably not. But it tells you something about the psychology at work here. They're trying to thread a needle, reduce exposure to Washington's balance sheet while maintaining some dollar liquidity and picking up extra yield in the process. Now let's talk about what they're buying instead. Gold. Lots of gold. The PBOC has been on an absolutely relentless gold buying spree. 18 consecutive months of purchases as of late 2025. Their reserves now exceed 2,250 tons. But even that number is probably understated. Why? Because China buys gold domestically and doesn't always report it immediately. There's speculation, backed by Shanghai Gold Exchange data, that their actual holdings could be 30 to 40% higher. Gold doesn't pay interest. It doesn't generate cash flow. But it also can't be frozen by a sanctions committee. You can't wake up one morning and find out your gold reserves have been immobilized because of a political dispute. That's the entire point. China's also pushing hard on the petroyuan. They're settling trade deals in renminbi with Brazil, Saudi Arabia, Russia, and increasingly with African nations. Every time that happens, China needs to hold fewer dollars for trade settlement, which means they need fewer treasuries as a reserve cushion. This is the part where people usually bring up the "there is no alternative" argument. Tina, The idea that the US Treasury market is so deep, so liquid, that China has nowhere else to put $3 trillion in reserves without causing massive distortions in other markets. And look, there's truth to that. The euro bond market isn't deep enough. Japanese government bonds yield next to nothing and have their own demographic crisis baked in. Emerging market debt is too risky. Gold is a store of value, not an income generator. But here's what the TINA crowd is missing. China doesn't need a single alternative. They're building a diversified basket. Some gold, some yuan-denominated assets, some strategic commodity reserves, some agency debt, some euro bonds. Death by 1,000 cuts. They're not trying to replace the dollar overnight. They're trying to reduce their single point of failure risk. There's another theory floating around that I need to address. Some analysts, Brad Setzer at the Council on Foreign Relations is the most vocal, argue that China isn't actually selling. They're just moving their holdings to offshore custodians in Belgium, Luxembourg, Switzerland, hiding the true scale of their exposure from US regulators. I looked into this. The data's messy, I'll admit that. The TIC system only tracks where the custodial account is located, not the beneficial owner. So if China moves $100 billion to a Belgian bank, it shows up as Belgium increased holdings and China decreased holdings. Same dollars, different label. But even if that's happening, and I think it probably is to some degree, it doesn't change the fundamental dynamic. Because those moves are also about plausible deniability. If things get ugly between Washington and Beijing, China wants to be able to say, look, we only hold X amount directly. Don't punish us. So what happens next? This is where it gets genuinely scary. Because the US needs to fund a $34 trillion national debt. And growing. The Congressional Budget Office projects deficits of $1.5 to $2 trillion annually for the foreseeable future. Somebody has to buy those bonds. For years, China was one of the top buyers. Not anymore. Japan's also been selling. The Federal Reserve finished its quantitative easing. So who's left? Domestic buyers, US banks, pension funds, insurance companies. But here's the problem. They're price sensitive. If yields don't go high enough to compensate for inflation and duration risk, they won't buy either. Which means the US Treasury has to offer higher interest rates to attract buyers, which means the cost of servicing the national debt goes up, which means more of the federal budget gets eaten by interest payments instead of infrastructure, defense, or social programs. Last fiscal year, the US spent over $800 billion just on interest. That's more than the defense budget, and rates are still elevated. If China keeps selling, and other foreign buyers follow, that number's going to explode. But here's the uncomfortable question nobody wants to ask. What if this is intentional? What if China's strategy isn't just about protecting their reserves? What if it's about weaponizing the US debt spiral? Every bond they sell puts upward pressure on yields. Every uptick in yields makes it more expensive for the US to finance itself. It's economic warfare without firing a shot. Do I think that's the primary motive? Honestly, no. I think the primary motive is self-preservation after watching what happened to Russia. But the secondary effect is real. There's a geopolitical angle here that doesn't get enough attention. China's not doing this in a vacuum. Russia's been forced off dollar reserves entirely. Iran never had much dollar access to begin with. India's quietly increasing its gold reserves too. The BRICS nations are exploring alternative payment systems. This is a coordinated or at least parallel move away from dollar dominance. Not because these countries love each other, they don't, but because they all share one thing in common. They've all been threatened, at one point or another, with being cut off from the dollar system. And once you realize that the rules-based international order has rules that can change overnight based on Washington's mood, you start looking for exits. Let me be clear about something. The dollar's not collapsing tomorrow. The US economy is still the largest in the world. The US military still guarantees global shipping lanes. American capital markets are still the deepest and most sophisticated. Those things matter, a lot, but the trajectory is what worries me. Because once a critical mass of countries decides they'd rather hold a mix of gold, yuan, euros, and bilateral currency swaps instead of treasuries, the feedback loop starts. Higher yields mean higher debt costs. Higher debt costs mean more bond issuance. More bond issuance means more supply. More supply without corresponding demand means even higher yields. At some point, you hit a tipping point. I don't know when that happens. Neither does anyone else. But the pieces are being put in place right now. Here's the part they aren't telling you in the headlines. This isn't about China being aggressive. It's about China being defensive. They looked at the Russia situation and decided they never want to be in that position. So they're restructuring their entire reserve portfolio to minimize political risk, even if it means accepting lower returns and higher volatility. The problem is that their defense looks like an attack from Washington's perspective, which creates a security dilemma. The more China de-risks, the more the U.S. feels threatened. The more the U.S. feels threatened, the more likely they are to use financial sanctions in the future, which makes China want to de-risk even faster. Classic game theory breakdown. Both sides acting rationally, but the system as a whole becomes unstable. So where does this end? 1. China continues the slow, managed drawdown. Yields rise gradually. The U.S. adjusts by cutting spending or raising taxes. It's painful, but manageable. The global financial system adapts. Multipolarity becomes the new normal. 2. Something triggers a rapid exit. Maybe a Taiwan crisis. Maybe a U.S.-China trade war escalation. China dumps hundreds of billions in treasuries in a short window. Markets panic, yields spike, global recession, financial chaos. 3. The U.S. finds new buyers, maybe oil-rich Gulf states, maybe a resurgence in Japanese demand. Maybe domestic buyers step up. China's exit becomes a non-event. The dollar remains dominant. I honestly don't know which one we get, but I know which one the markets are not pricing in. Scenario 2. Everyone's assuming the managed decline. Nobody's preparing for the fire sale, and that's what keeps me up at night. Because the truly destabilizing events in financial history are never the ones everyone sees coming. They're the ones that seem impossible right up until they happen. China's been reducing Treasury holdings for years. Most people shrugged it off. Just portfolio management, tactical adjustments, nothing to worry about. But the data doesn't lie. The pace is accelerating. The motivations have shifted from economic to strategic. And the alternatives, gold, yuan assets, bilateral trade, are being built out systematically. This isn't a shot across the bow. It's a lifeboat being quietly lowered into the water, while everyone else is still partying on deck. The question isn't whether China's serious. The question is whether the rest of the world figures out what's happening before the music stops.